very warm welcome to all our viewers. You're watching the fundamentals of investing on your story. Now, given the current backdrop of India's GDP contraction in quarter 1 and all the discussion and debate on the future and further growth potential within the country, it is, of course, appropriate and pertinent to discuss about the future of your investments at this juncture. And when it comes to investments, diversification, of course, helps in adding more value and balancing out the risks. And could adding global investments to your portfolio help in adding more value added stocks as well as give you the opportunity to explore newer avenues of growth? For all this and discussion on the future of the mutual fund industry, we are joined by Chandresh Nigam, who is the MD and CEO of Axis Mutual Fund. He has been with them for over a decade and has been credited with the successful conceptualization of the fund management's philosophy as well as processes. So thanks, Chandresh, for your time today and for joining us on the Wires platform. Great to connect with you. My first question to you, of course, is that given the current situation in India amidst the pandemic, and in fact the world over, we are seeing significant weakness and a slowdown in the economy. So, in this light, what would your investment strategy be? Or would you look globally for equity investments, or would you focus more on the domestic market story?
So when we are talking about investing in equities, we are talking about building wealth for our customers, investors. And it's always good to diversify. I mean, you want equities is an area of risk. Not everything goes as per plan. So people should always look to diversify. Whether we are building a domestic portfolio for our clients in many of our mutual fund schemes, or if you are building it on your own, you should always kind of diversify. Now, so the many years right now, the Indian markets have been showing good promise. There are a large number of Indian companies which have been doing well. And from that perspective, it is not too difficult to build a portfolio of high quality growth businesses, which is where in the entire world, all the wealth has been created. Yeah? So while there may be thousands and thousands of companies, only the sustainable high quality ones actually create wealth. From an Indian investor's perspective, more than 99% of his wealth is in India. Now, when we are asking people to put money in equities, what the investor should really be bothered about is, do I have the best opportunities captured in my portfolio, in the sense that are these the best 40, 50, 60 stocks which I should be owning worldwide. But over the last 4 or 5 years, because the economic growth has come down, our overall corporate profit growth has come down. That's not to say that we don't have investment opportunity. We still have investment opportunity. But then they are in some sense getting similar to maybe some of the really high quality opportunities available globally. So I think this is a good time, especially with the pandemic, as you mentioned, the risks to various economies, various markets are uneven now. We don't know how if everything will move together. There could be some economies, some sectors which will do better than the others. So it makes sense to diversify. Also, from an opportunity perspective, exploiting opportunities, this is the environment is such that technology related, high technology, disruptive businesses, they are really gaining ground. Despite low overall global growth, these companies are expected to do well, and unfortunately, these companies are not there in the Indian market. So necessarily, we will have to go abroad to diversify our portfolio at one level, and at the second level, really exploit some of the other opportunities which are not available.
Right, interesting point you made there, Chandresh, on the fact that, the entire disruptive tech space and the startup ecosystem is not really listed and accessible to equity investors here in India. But when you look globally, we have seen tremendous growth stories in global companies and tech giants such as Amazon, Facebook, and the Apples of the world, legacy Microsoft, as well as companies like Nike and Adidas. Despite the current situation, we've seen good growth there. So, what are the platforms available for Indian investors to park their funds in these kind of companies?
So I think once we establish the fact that Indian investors should diversify their portfolios and look to invest globally, then there may be some opportunities. There is the LRS route in which people can go and buy these stocks directly. There is the LRS route again, and they can buy some funds globally. But I think there are some interesting options which are coming in the local market. So, like the way they buy a domestic mutual fund, they can buy a domestic mutual fund which has exposures and has the ability to buy international stocks. Now, whether it does it directly and buys these stocks on its own, or it then invests into another fund which is well known for its stock picking and portfolio management capabilities, and invest in that fund, and then whatever are the holdings of that particular fund, in a sense, the Indian investor through the Indian fund can get beneficial interest in that. So there are a number of options available, but the easiest one seems to be to just invest in a what we call as feeder fund. So invest in an Indian fund. The approach to investing is the same. The operations in terms of purchase, redemption, etc., all remains very easy the way it is. An underlying fund will invest in a global fund, which takes educated calls and manages that portfolio, manages a global portfolio on behalf of this investment.
Right, and talking about global opportunities for investment, how are you really viewing the global market right now? How is it poised for growth in the near term? Well, I guess we are all, of course, riding the pandemic wave in the near term, but in the mid to long term, how are you really viewing the global market?
Yes, so as I said in my early remarks, I think we are in a scenario of low growth around the world, whether it is in India, whether it is globally. Now, obviously, this financial year is we are going to see a very low growth, and in many cases there may be very significant drop in earnings. So expectation would be the next year, which is financial year 21-22, will be much better. But the reason to buy stocks is not that. The reason to buy stocks is what happens from a next 3 to 5 year perspective, especially when we are talking about long-term asset allocation, which we are very big proponent of, and hence kind of add to your wealth building efforts. In that case, overall slow economic environment means that you have to still go out and search for high quality and high growth businesses, which is what is lacking, because it can be very easily understood. If the growth is 10%, then you can expect lot many more companies to do well. If growth is now in India about 5, 6, 7%, and global growth is 2, 3%, now you have to really find those businesses which even at such lower rates can still grow their profits and businesses over the next 3 to 5 years at 15 to 20%, which is what we are really looking after. So I think it's a great time for people to look at both opportunities. One is domestic, which is again high growth, high quality businesses, which will do well next 3 to 5 years. And similarly, look at a few high quality global companies. And they're certainly there because of the strength they have in technology. And it's not just the high-tech space. High-tech space is one big one which completely stares us in the face. But there are things happening on the healthcare side, consumption side, mobility side. There are lots of things happening, technology and other spaces as well. So make a portfolio of 40, 50 stocks. Diversified portfolio is what I would recommend to all investors from a global perspective. That is obviously, most of the investors already have a domestic portfolio of high quality growth businesses. Put the two together in a portfolio of maybe 25 to 30% international and the rest domestic. And I think it will really add to an investor's long-term wealth building efforts. At the same time, it actually reduces risk, which is very critical in this environment.
Right. So you are, of course, strongly recommending that you have a variety of eggs in your basket. And then, hence, would you say that investing only in one market geographically could raise the risk levels of an investor?
It's not as if that it raises. I mean, the
Hmm.
point is it is always more risky. So let us look at an American investor. Now, the US markets already are more like 40, 50% of the global markets. But if you were to invest just in the US, your risk will be 20% higher than what if you had maintained a global portfolio. Similarly, if you just had an Indian portfolio, your risk would be maybe 30, 35% higher. So diversification is a good thing. It's giving you one opportunities to exploit, and two, at the same time, miraculously, it's also reducing your risk. So I think it's just a must have in your portfolio, must diversify across geographies, across sectors, across countries. I think very, very critical.
Sure. Now, talking about the Indian market in specific and the investor appetite and how that is really shaping up. In the Indian market in particular, how are you viewing it in the current scenario given the COVID-19 situation? Have you seen fund managers rethink the growth potential here in the country? What are the feelers and the sentiment that you are really getting out of the market?
So I think the market has been reasonably smart. I think while the sentiment had turned very negative, people were very fearful in March and April. I think the market slowly started to recognize that this is not the end of the world, so to speak. And so I think the markets looked at two or three different opportunities, if I were to say, in the overall market. So one set of companies are what we call as the resilient businesses. I think people figured out that despite the COVID lockdown, people are still going to buy the staples, so the day-to-day use things, food items, and all that. I think so. That's something which recovered very quickly. IT services, people figured out will be more required, so that kind of recovered quickly. The second phase is what is the rebound story, the recovery story. So while they were not resilient in the first couple of months, but then people realized that things will come back. So whether it is automobiles, personal mobility, in some sense, some more capital-intensive businesses, etc., at the margin. I think these are the ones which kind of have recovered, and also some of the consumer discretionary plays, because there is a pent-up demand and there is things happening. And the last category is the momentum plays, the momentum which is actually benefiting from these COVID pandemic. So online stuff, payment gateways, etc., where we do not have much of a exposure in the Indian market. So these are the ones which, as we talked about, the tech majors globally, I think they are some real beneficiaries of that. So from that perspective, market moved back up. They're obviously sensing that in maybe a year's time, everything will be absolutely back on track. And if that is the case for a large number of businesses in the country, then it makes sense for the markets to go back up. There will still be some high touch, high physical touch businesses, the entertainment, the hospitality, etc., which is going to take some time to recover, and many of the businesses may not fully recover. So those are obviously areas which the market is not fully confident of, and that as the time goes by, we'll see how the recovery really takes place. So markets are, I think, fairly right in terms of discounting what the medium term future looks for a large number of businesses.
Sure. So you are, of course, envisaging a recovery at the end of the day. But given the volatile market, and of course, like you said, there is a bit of a negative sentiment right now. Is it making investors wary of equities and mutual funds? Because we are seeing a lot of people scouting for traditional safe havens such as gold at the moment. And what would your advice be to such investors right now?
So I think if you look at it, if we are all agreeable to the scenario that maybe 12 months from now, restrictions which are right now because of pandemic are there, will no longer be there, and we can model a reasonable recovery and going back to some normalcy in the economy. And from that perspective, hence whatever was your business your asset allocation, that is something which one should follow. So our call or our advice to investors always is, depending on your risk appetite, have the amount of risk assets, which is equities, have the balance largely in fixed income. And then from a insurance perspective, because at the end of the day, there is a lot of liquidity sloshing around, etc., maybe 3, 4, 5% of exposure should be in hard assets like gold, etc., to kind of look at a scenario where suddenly currencies start to kind of depreciate, etc. So that's how it will be, and I think that's the recommendation. We are also sensing that this might be a period where fixed income will not do well. Globally, I think rates are very low. Even in India, the rates have really come off. The next big move in bonds seems to be upward. So anyway, so not that you will make too much money there. Obviously, we cannot just, because bonds are not going to yield high returns, doesn't mean that we put all the money in equities. But yes, if you are underweight equities as compared to your target asset allocation, then we should look to correct it. And within the equity space, as we said, that global equities, I think, is providing a good risk return addition to your overall portfolio. It reduces the overall risk while giving you opportunities to exploit, to be exploited globally.
And when it comes to mutual funds in particular, what would your advice be there? Because in the recent past, we have seen several outflows from the Indian mutual fund industry. So, why should investors really stay put and hold on to their mutual fund investments?
I think mutual fund in that sense, from an equities perspective, is medium to long-term wealth building asset class. We will have these periods where suddenly the sentiment becomes very weak, and then your resolve to maintain an asset allocation gets tested. And this is a time essentially when you should be sticking to the asset allocation. In fact, maybe because equities have still not got back to their original levels, maybe the equity value of the portfolio as a percentage of the overall portfolio has come down. So rebalance it, probably put in more money. Because long term, that's what happens. I mean, we don't want to get knocked out of the market just because sentiment is poor. We've seen this happen a number of times. Eventually, if the underlying businesses continue to do well, equity stock prices do go up, and you don't want to miss out on that whenever it happens. And I think that is going to happen next 2 3 years. Yes, this year is bad, but next 2 3 years, strong companies will become even stronger, and stock prices eventually will go up. So there's no real reason to, just because you are fearful, to just get out of markets, just get back to your asset allocation. I think that would be the right thing to do. Maybe 3 4 5 years from now, this whole large fall which we saw in February, March, uh, will just be seen as a blip, as we have been seeing the past ones. Let's say the 2000.com or the 2001 9/11 or the global financial crisis, etc. I think long-term charts, these will just be, there will be sharp correction, but it just look like a big blip. And then the economy marches on, and so does the stock market.
Right. And interestingly, you have also launched a great fund called the Axis Global Equity Alpha Fund of Funds. So, if you can tell us a little bit more about this fund, what really drove you to come up with this NFO at this point in time, and what kind of investors could look at investing in terms of their risk profile as well as the portfolio?
Sure. So this whole thing about equity diversification into global markets is not something new to Axis. We've been doing this and thinking about it and doing this over the last 3 4 years. In fact, about 2 years back, we launched Axis Growth Opportunities Fund, where we said, as a first step, let's put it in a product which is easily understood by retail investors. So 70% was in Indian equities, which most people understand, and 30% was allocated to global equities. So the benefits of diversification and exploiting global opportunities has been a thought for some time, 3 4 years now at Axis. And then earlier this year, we did another fund called the Axis ESG Fund, again with a similar structure, 70% in Indian companies which have strong ESG, they run their businesses with ESG principles in mind, and 30% on global businesses which have ESG as a dominant theme. And both these funds have done fairly well in this period. And so this time we've decided that maybe the markets are also getting ready for 100% global product. And that's why the Axis Global Alpha Equity Fund of Fund, which will invest in our partner Schroders Global Equity Alpha Fund. So it's a fund which invests in about 40 to 50 high conviction ideas. So it can invest anywhere in the world. So it is not just focus on, let's say, the US market or the European market. So wherever it finds the right opportunities, could be in emerging markets, it could be Europe, it could be Japan, it could be US. Certainly US is a large part of the allocation. And that allows a single stop shop for investors who are looking to kind of take advantage or exploit global opportunities. And you can just do it by one single fund. So any investor, any retail investor, HNI investor who doesn't have exposure to global stocks, which is the case for most investors, 99.5% of assets of Indian investors in equities is sitting in India. So that money has not gone out. And if that, so I think it can be the first product to now make a meaningful allocation to global markets.
Sure, it's great that you say that your fund can be seen as a one stop shop for global equities, and it is a fund of funds, as you mentioned. You also brought up Schroders. Of course, we do know that it's a legacy institution when it comes to investment management. So, give us more details about what Schroder ISF Global Equity Alpha really plays when it comes to your fund.
So now, if you want to really invest in global markets, you need expertise. I mean, a large team, hundreds of analysts tracking maybe about 2,000 to 3,000 investment-worthy companies all over the world. So Schroders is a fairly large name, one of the largest asset management companies out of Europe, listed on the FTSE exchange. It's a 200-year-old fund, 150 years in asset management. So they've built up all those capabilities, and they have been investing globally for a long, long time. Okay, and this particular fund into which the Access Fund will feed into has been around for 15 years. It's got a quite a sound track record over this period. Recent performance has been actually better than that, been quite strong. And as I said, I think at the end of the day, investors will benefit from growth of businesses medium to long term, irrespective of benchmarks, irrespective of which geography they are. So this fund allows us to go anywhere, seek out the best ideas for our investors. So along with Axis's style of investing, basically sustainable growth, sustainable strategy, complemented by Schroeder's own style, which is no different from Axis, and their expertise and the capability and the teams and the process. I think it's a win-win situation for investors.
Right, and what kind of growth can investors really expect from their investment in Axis Global Equity Alpha Fund of Fund? When you look at the fund manager's investment philosophy, what is your thinking when it comes to that?
So the fund manager's philosophy is all about exploiting growth opportunities. Some cases, sometimes what happens, the company might be growing very rapidly, but that is probably already all discounted by the market. So in a sense, it's about trying to trap what are we call as growth gaps. Normally what happens is when you come across a very high quality company, markets, because of their tendency of looking at the near term on 2 years, sometimes takes a call that, hey, the growth is there for the next 2 years, and after that the growth is likely to taper off, which is what generally happens sometime in the life cycle of any company. But if you can analyze a business and say this company is going to do well, not for 2 years, which is what the market is focused on, but more like 3, 5, 7, 10 years, then there is a massive arbitrage which is available between what you are looking at and what the rest of the street is looking at. So that's what we call as a growth gap. So that's the idea, trying to find businesses which are where the growth is not fully discounted in current prices. It is no different from what Axis does. Axis prides itself today in really building high quality growth businesses. Sometimes people do ask us that, hey, the PE multiple of your fund is or your stocks is high. But that is only if you look at the next 1 or 2 years of earnings. If you can project that with high degree of predictability, accuracy, that 5 years on also this company is going to keep growing, then your holding period return actually is reasonably good, even if current short-term valuation metrics, it looks expensive. So that is the strategy of the fund, that get into these what is called the core high growth businesses, which are not where valuations are not discounting the entire growth story. They are able to take advantage of that. The second and smaller piece of the portfolio is maybe 20 to 30% allocation in what is called as, people have this tendency again to just project whatever has been happening in the past and say that if the business has been growing at 10%, it will continue to grow at 10%. So inflection points at times are really missed. So if you have good, strong analytical framework and number of analysts who are watching companies carefully, there will be opportunities where some of these companies may not be very long-term great businesses, but from a 1.5 to 2 year perspective, they may give up. They may surprise the street on the upside. So it's what we will call as a cyclical growth, which is not discounted by the markets. Eventually, the style of investing is all about growth, that we have to have businesses which are really worth it, high quality, but some of them may be really exceptional businesses from a long term. Others may not be that exceptional, but yes, there still are strong businesses and may do much better than what the market expects over the next six to 8 quarters.
All right, very nicely put there, Chandresh. And I would like you to leave us with some of your closing thoughts, really, on the future of the mutual fund industry, and also a specific question I'd like to ask you about your NFO. It's already launched. What kind of response are you seeing? And did you really view this as, in a sense, a kind of an opportunistic time to really launch the fund?
So I don't think you can do anything. Answering your second question first. I think there is a cycle by which you design a product, then you go in for regulatory approvals, and then you come and launch it. So it's a cycle which takes anywhere from 6 months to 12 months. So it's not nothing opportunistic about it. I think this is a place where we want investors to really take steps to diversify their portfolio. One thing about Axis has always been that we've always been 100% customer centric. Only those strategies which long term make sense is where we would really go. So while we can never know what will happen to global markets, Indian markets next 1 month, 2 months, but again, from a 3-year, 5-year perspective, would this strategy be relevant? Absolutely. So I don't think there's anything opportunistic. It's just that more people have already started talking about global markets. There is a way which people have realized by which they can play more emerging global themes which we can't play in India. So I think from being just a desired diversification tool, I think now it's also about trying to unlock or exploit global opportunities. The mutual fund industry has been growing at a good pace the last 5 years, certainly. 10 years, little lower than the 5 years, but certainly growing. Nominal GDP, 10-12% growth. Financial savings will rise. Real estate, gold, not really preferred asset classes. So I think it's an area where financial savings will certainly go into. And also, if you are not happy just with savings and you want to invest, it means wealth creation. We'll have to get into other asset classes, equities being one of them, global equity, and then there could be other similar products from time to time. I think there is great growth potential, and it will continue to happen. Even in today's market, the last 6 months have been particularly challenging. But in terms of number of investors, number of new SIP accounts, etc., I think there is still reasonable flow. It's not as high as what we used to see earlier. But even in these bad times, from a sentiment perspective, there's still 7-8 lakh new SIP accounts opening up, new gross sales in equity coming of 18 to 20,000 crores. I think once the sentiment improves, year down the line when we are near normalcy, I think we can then look forward to now going back to our earlier levels of flows, which it has been as high as 30 to 40, and in some months even 50,000 crores in a month. So I don't think that long-term story changes at all. The demographics, savings rate, move to investments. I think these are going to be long-term stories. And there's another very important factor, which is about lower interest rates. I think that will also make people move a little bit more towards within bonds also to non-deposit kind of or in fixed income towards from non-deposits to mutual funds and also to equity and hybrid instruments. So I think it's all really well lined up. Yes, unfortunately, when there is poor sentiment, the flows do get volatile. But the long-term direction and trend, I think, is just one way. There can be no doubt about that.
Right. So the long-term story does stay intact. Thank you so much, Chandresh, for sharing your deep insight and understanding on equities and the mutual fund industry, of course, and also giving us a bit of advice on how to stay invested and diversify our portfolios to balance out risk. And all the very best, of course, with your new fund offer. Thank you so much again.
Thank you very much. Wonderful to be here. Thank you.
Mutual fund investments are subject to market risks. Read all scheme related documents carefully.